Bitcoin's more valuable than water? Or Bitcoin's more valuable than... No, dude, that's not what I'm saying. In the same way that I'm not saying diamonds are more valuable than water. What I'm saying is I'm making a decision at the margins. I have money that I need to save. I created value. I have value left over. I paid the phone bill. I paid my YouTube TV bill. I paid my credit card bill. I paid my rent. I did all the things that I need to do, and I have some cash left over, and I want purchasing power in the future. So I have a decision to make, and this is the decision I'm making. That's it. That's how Bitcoin is valuable. And take yourself back to Silk Road. When someone says, I want to buy drugs on the internet, how do I do that? They made a decision at the margin to say, well, I couldn't have used cash. I couldn't have used PayPal. I couldn't have used Venmo. I couldn't have used Cash App. So I used Bitcoin.
Bitcoin's price is one of the easiest things in the market to focus on, particularly during periods when momentum disappears and investors begin questioning whether the long-term thesis has been overstated. But price alone tells us very little about the fundamental question that ultimately determines whether Bitcoin can become a major financial asset. Why should anyone choose to hold it in the first place? Investors can hold cash, government bonds, equities, gold, real estate, or a growing range of digital assets, and every one of those choices represents a different way of preserving purchasing power and positioning capital for the future. Bitcoin, therefore, does not exist in isolation. It is competing for the capital that people have left over after they have satisfied their immediate needs. The Bitcoin thesis is ultimately built around the idea that money itself is an asset with properties that matter, and that individuals and institutions will increasingly evaluate those properties when deciding where to store their wealth. Bitcoin offers a combination that is difficult to reproduce in the traditional financial system: a strictly limited supply, an open monetary network, global portability, self-custody, and a monetary policy that can be independently verified rather than simply trusted. None of those characteristics guarantee that Bitcoin will appreciate, but they explain why a growing number of investors view it as a fundamentally different form of monetary asset. And as the financial system becomes increasingly digital, automated, and eventually more dependent on autonomous software, the characteristics of the underlying money could become even more important. That is the framework Jack Mallers uses to explain why Bitcoin has value, and why the most important competition for Bitcoin may not be another cryptocurrency at all. It may be everything else people could choose to hold instead. Before we continue, make sure you subscribe to the channel if you want more analytical coverage of Bitcoin, macroeconomics, liquidity, monetary policy, and the technological changes reshaping the financial system. If you find this type of analysis valuable, make sure to leave a like as well, because it helps us continue bringing these conversations to a wider audience.
You can think of money as having these 3 jobs. It holds work you've done for later. So if you've worked and produced value, but you don't want to turn all that production into consumption, you're not hungry yet, you don't want to choose where to live for the next 20 years yet, you don't want to buy your vacation flight yet because you haven't talked about it with your fiance, then you need to hold the value over for a time being before you later exchange and consume from the market. Money also helps you move it across to someone. So holding it for later moves it across time. How do I take value that I created today and move it across a year, 2 years, a decade, 100 years? How do I store value today till the year 2126? Okay, you also need to move value across what we call space, distance. So how do I move value that I'm creating in Chicago to New York? How do I move it to London? And then the third, which is relevant to this episode, is money is used to compare unlike things. So how do I compare the value I'm creating at Strike to the value that's being sold at Whole Foods? The butcher that I'm buying my steak from has no idea what Bitcoin elliptic curve cryptography is, and I have no idea what it's like to raise cows. So how do we create a marketplace that allows us to exchange this subjective value that different people are applying to the goods and services that we're creating for the market? And so again, you hear a lot of Bitcoiners talk about, well, money is about moving value across time or across space because that's what saving and exchanging is. But you also have to, now when it comes down to value, subjective value, You have to understand that money has a third job, which is moving value across choices, is what I have written here. Across these decisions. How do we subjectively value? I want all these things for myself, and we all want all these things. That is the human condition. That is what it means to be human. And you then have to make choices as to what things available to you in the market, because not everything is available to everybody. Some people can get planes and professional sports teams and hire all sorts of engineers, and some people can barely afford ramen noodles. So you could want all the things that you want, and then you have to look at the market and see what options are available to you and start making choices, and that is economizing. So now we get into Bitcoin. So hopefully that was very digestible, easy to understand. What is value? How does value emerge in an economy? Value is entirely subjective. It's not baked into the thing. Gold has no value inside of it that Bitcoin does or does not. Value is subjective. Okay? So, what does Bitcoin serve? Okay? Bitcoin theoretically competes in the marketplace for money. It serves this idea of you do work and you spend your time doing stuff, and then you want money in return for that so that you can later consume, and you need purchasing power. Let's take a look at this idea of a market for money. So again, value is all about us wanting something and then having to make a choice as to how to acquire what we want or how to work toward what we want. So let's take a look at what can go wrong with money. And this is a short list. I could have made this list 100 items long, but some of the things that can go wrong, someone can make more of the money that I save in, which would inflate. That's highly inflationary. It would debase my savings. So that's a problem. Someone can seize my money. So if I have to store my money in the possession and in the hands of someone else, they could just decide that my money is their money. That's a problem. It can be expensive for me to use my own money. So if it's on inefficient rails, if it's sitting in between a lot of intermediaries, then there's a lot of economic friction for me to use my money. Like it costs 2, 3, 4, 5, 10% just for me to use my own money. That's a problem. The rules of the money can change without my consent. So again, if it is with someone else or if it's in a system that I don't control or that doesn't respect me, then the rules can change. And then another one is that I can't verify any of it myself. That's a problem. Now, again, this list could have gone over and over and over and over again. But you start at a place where a human has wants. And I'll speak for myself. Now, I would assume that many humans share the same wants that I have when it comes to money, but I don't know that for certain because I'm not them. It's all subjective. But I'll just talk about myself. What do I want? I want a money that is fixed in supply. I want a money that is fairly reasonable for me to own myself so that I do not have to, if I don't want to, trust someone else to hold it for me without the threat of seizure. Even if it isn't the company that's going to seize it from me, maybe the government makes the company seize it from me, I want to be able to hold it myself. Okay? I want it to be fairly cheap and sometimes free for me to use, especially free for me to receive. I do not want to pay 2, 3, 4% to have to receive money and value to myself. I want to ensure with real credibility that nobody can change the rules. I want to be able to verify with math that every day I wake up, the rules, in fact, have not changed. Right? These are all things that I want. I want these things. So now I have to go about making a choice to acquire what I want in the marketplace. I can choose dollars. I can choose gold. I can choose pounds. I can choose real estate. Based on the properties that I want, this is what Bitcoin actually does. You can hold it yourself fairly reasonably. It costs you nothing. You do not need to pay a vault. You do not need to pay auditors. You can literally hold it yourself on your phone. It can move anywhere. Nobody can make more of it. Anyone can verify it. Nobody can control it. The rules, in fact, are fixed.
At the most basic level, people work today because they expect the value they create to give them access to goods and services in the future. They therefore need some mechanism for transferring purchasing power through time. And the monetary system becomes the infrastructure through which that purchasing power is stored, transferred, and ultimately exchanged. The problem is that not every form of money performs those functions equally well. A monetary asset can lose purchasing power as its supply expands. It can become difficult or expensive to transfer. It can depend on intermediaries that introduce counterparty risk, and its underlying rules can ultimately be changed by institutions that the holder has no direct control over. These are not theoretical characteristics. They are some of the fundamental trade-offs investors already consider whenever they decide where to keep their savings. Bitcoin's proposition is that many of those constraints can be addressed at the protocol level. The significance of that property becomes clearer when economic activity increasingly takes place between digital entities that operate globally and continuously. A world in which machines can transact at any hour creates a natural demand for financial infrastructure that is equally native to the internet. Bitcoin was designed for precisely this kind of environment. Whether it ultimately becomes the dominant monetary asset within that system remains an open question, but the possibility itself helps explain why Bitcoin's long-term relevance cannot be measured exclusively by its current market price.
So when we take a step deeper, we say, okay, Bitcoin's competing for this money thing. So what's it competing against? Cash, stocks, bonds, gold, real estate. So when someone says, how could Bitcoin possibly have any value? Well, you have to understand, people are making these decisions at the margins. Like we said, someone is waking up and saying, okay, I paid my phone bill, I bought my groceries, I paid my rent, I have leftover money, whether it's $1, $10, $1,000, $1 million, and I want to save that money. Here are the choices I have, again, because we want to have more purchasing power in the future. Let's go back. All of this starts from the human condition that we all want. We want a future, a better life. We have desires. And that is the amazing part about being human, is we're so future-oriented. We have an ability to lower our time preference. We have ability to prioritize the future. So what do I want? I want purchasing power in the future. What are my options to achieve that? Well, I can keep cash. I can invest in stocks. I could buy bonds. I could buy gold. I could buy real estate. Let's walk through each. Cash, no thanks. Because the amount that they're debasing it by printing more, my purchasing power is going to get entirely eroded. And inflation is a modern day crisis everywhere you go. Okay? Stocks, I'm taking counterparty risk on given companies. And by the way, stocks have not outperformed gold since the year 2000. So I do not want to take counterparty risk against leadership teams and products that I don't understand. And I also don't want to invest in an asset class that can't outperform, a metal. Bonds, I'm not even going to get into that. No, absolutely no thanks. Similar to cash. Gold. I don't want to store a bunch of gold in a vault in my house. I don't want to pay someone to store the gold for me. Gold has already been confiscated by the government. I don't know why it wouldn't be confiscated again. It's an analog metal. And I have no interest in trying to figure out how to sovereignly store a bunch of gold. In real estate, I do not want that counterparty risk. I don't want to have tenants. I don't want to have to pay property tax. I don't want to have risk of natural disaster. So I work through, and this is just me personally. Everyone makes their own subjective valuation. But me personally, I look at all my options and I say, okay, I want purchasing power in the future, because in the future, I might want a car. I might want a new house. I might want to buy the Chicago Bulls. I might want to fly private. I might want to have a nice dinner. I'm going to want a lot of things, and I need purchasing power in order to have the life that I want, or to protect myself from bad things happening. Inevitably, someone's going to get sick. Someone's going to have an accident. Someone's going to need something from me. I'm going to need purchasing power, or at least I want purchasing power. And I look at all my options and I say, okay, hey, Bitcoin is the one I elect to choose. So at the margin, I am assigning value. And people sometimes will think, what are you saying? Like Bitcoin's more valuable than water? Or Bitcoin's more valuable than... No, dude, that's not what I'm saying. In the same way that I'm not saying diamonds are more valuable than water. What I'm saying is I'm making a decision at the margins. I have money that I need to save. I created value. I have value left over. I paid the phone bill. I paid my YouTube TV bill. I paid my credit card bill. I paid my rent. I did all the things that I need to do, and I have some cash left over, and I want purchasing power in the future. So I have a decision to make, and this is the decision I'm making. That's it. That's how Bitcoin is valuable. And take yourself back to Silk Road. When someone says, I want to buy drugs on the internet. How do I do that? Well, they made a decision at the margin to say, well, I couldn't have used cash, I couldn't have used PayPal, I couldn't have used Venmo, I couldn't have used Cash App, so I used Bitcoin. Now, you could politically agree or disagree with the decisions they were making, but the point is they found Bitcoin useful, therefore there was demand for it, therefore it had value because there's more demand than there is existing supply. It is not like air, it is not plentiful. Prices emerge from these marginal choices. Every possible buyer asks, would I rather hold this or something else? Every single day I wake up and I could sell all my Bitcoin and own other things, but I don't. I'm making the decision every day at the margin to own Bitcoin. So every possible buyer asks, would I rather hold this or would I rather hold something else? Every current holder asks, would I rather keep this or would I rather buy something else? So nobody uniquely alone sets Bitcoin's value. The price is what is left over after these decisions that emerge from the marginal choices that we all make. You understand? So Bitcoin is only worth something because people value what it can do for them. Again, going back to the early slides in this deck, it is somehow satisfying a need that somebody has. And its scarcity is relevant and matters because the demand that people have for it cannot be satisfied just by making more Bitcoins.
People create value, consume some of that value today, and then decide what to do with the purchasing power that remains. Every one of those decisions creates a competition between different forms of money and different stores of value, and Bitcoin is attempting to win a portion of that competition by offering a monetary asset with properties that are fundamentally different from those of traditional financial instruments. That does not make Bitcoin risk-free, and it certainly does not mean that every investor should own it. Bitcoin remains volatile, regulatory frameworks are still evolving, competing forms of digital money are developing rapidly, and the ultimate demand for a decentralized monetary network remains one of the market's biggest unanswered questions. But those uncertainties should not obscure the underlying thesis. Bitcoin is not valuable simply because its price has gone up in the past, and it is not valuable simply because its supply is limited. Its value proposition comes from the possibility that people will increasingly prefer the properties of this monetary network to the alternatives available to them, particularly as the economy becomes more global, digital, programmable, and increasingly mediated by autonomous software. That is why the most important question may not be where Bitcoin trades next month or even next year. The more important question is how much of the world's future purchasing power people will ultimately decide should exist in a monetary network that no single government, corporation, or financial institution controls. If that share continues to grow, Bitcoin's role in the financial system could become substantially larger than its current market capitalization suggests. Thank you for watching. If you found this analysis useful, make sure to check out our other video featuring insightful analysis from some of the brightest minds in the industry, where we continue breaking down the ideas, trends, and macro forces that are shaping the future of Bitcoin and global finance. If you enjoyed the video, make sure to like it, subscribe to the channel, and turn on notifications so you do not miss our next analysis. And once again, thank you for watching.